Comcast just had its best single trading day in 18 years. The stock jumped 9% in a single session. That has not happened since 2008. And the reason behind it tells everyday investors something far more important than a simple headline. Comcast announced it is spinning off NBCUniversal and Sky from its core cable business. It is one of the most significant corporate restructurings in American media history, and most investors have no idea what that actually means for their money. So today, we are going to answer that question directly. What is actually happening at Comcast? Why are they doing this right now? What does it mean if you own the stock? And what does this restructuring reveal about the broader media economy in 2026? Let us start with the basics. Asterisk, asterisk. What actually happened this week? Comcast has spent decades building an empire. Cable infrastructure, broadband internet, NBC, MSNBC, CNBC, Universal Pictures, Sky in Europe. For a long time, that bundle of assets made sense together. Cable subscriptions funded content. Content kept subscribers on cable. It reinforced itself. But that loop has been quietly breaking apart for years. Streaming killed the old cable bundle. Cord cutting accelerated faster than anyone in boardrooms wanted to admit. And now, Comcast is acknowledging what the market has been pricing in for years. The assets are worth more apart than they are together, so the decision was made. NBCUniversal and Sky will be separated from the core Comcast cable and broadband business. Two separate companies, two separate stock listings, two separate futures, and the market celebrated with a 9% jump on the day of the announcement. Asterisk, asterisk. What does a spinoff actually mean for everyday shareholders? This is where most people get confused. A spinoff is not a sale. Comcast is not selling NBCUniversal to someone else. Instead, it is creating a brand new publicly traded company. Existing Comcast shareholders will receive shares in the new spinoff company. You will still own your original Comcast shares, but now you will also own shares in the newly separated entity. Think of it like one company deciding to become two separate businesses overnight. Your ownership does not disappear, it just gets divided differently. Now, here is the part that matters most to investors. After a spin-off, both companies are free to make decisions that the combined entity never could. The cable business can focus entirely on broadband growth. The media business can chase streaming partnerships, licensing deals, or even a full acquisition. That freedom is exactly what markets are pricing in today. Asterisk, asterisk. Why is this happening right now in 2026? That is the real question worth asking. Corporate spin-offs do not happen randomly. Companies restructure when management believes the market is undervaluing what they own, and right now, legacy media companies are caught in a brutal valuation trap. Wall Street looks at a company like Comcast and sees a declining cable business. It discounts the entire stock because of that fear. Even if the film studio is profitable, even if Sky is still growing in Europe, the cable decline contaminates the entire valuation. Separating the businesses forces the market to value each piece individually. A broadband infrastructure company gets priced like a utility. A media and content company gets priced on its own streaming and licensing potential. Suddenly, the sum of the parts is worth more than the whole. That math is exactly what drove a 9% single-day move. If you are finding this useful, consider subscribing for more practical financial insights. Asterisk, asterisk. Is this specific to Comcast or part of a bigger pattern? This is where things get genuinely interesting. Comcast is not alone. Legacy media across the entire industry has been quietly unwinding the old bundled model. Warner Brothers Discovery has been restructuring relentlessly. Paramount has been through merger talks, spin-off rumors, and ownership changes. Disney has been under pressure to separate ESPN for years. The pattern is consistent. Enormous media conglomerates built for the cable era are being pulled apart, because the cable era is over. Broadband internet is the new cable, and content is now distributed globally through apps, not cable boxes. The companies that recognize this shift early and restructure deliberately tend to outperform. The ones that wait until the decline is undeniable tend to get acquired at a discount. Comcast is choosing to restructure on their own terms. That distinction matters. Asterisk, asterisk. What should everyday investors actually watch for with spin-offs? Here's the practical lens most retail investors never apply. First, watch what the parent company keeps. Whatever Comcast keeps after separating NBCUniversal tells you where management sees the real long-term value. They are keeping the cable and broadband infrastructure. That is the business generating the most predictable cash flow. Broadband has no serious competitor in most American markets. It is a near monopoly in millions of households. Management keeping broadband is a signal, not an accident. Second, watch the new company's debt load at launch. Spinoffs sometimes saddle the new entity with debt from the original company. If NBCUniversal launches with heavy debt, it limits what that business can do next. Debt-heavy spinoffs historically underperform their leaner counterparts. Third, watch institutional investor behavior in the first 90 days. Many institutional funds that own the parent company cannot own the spinoff. Their mandate may only allow broadband or telecom holdings. When the spinoff begins trading, they will sell it immediately. That often creates a temporary price dip in the new company. For patient individual investors, that dip is sometimes the real opportunity. Asterisk asterisk. What does this mean for the broader market this week? Comcast's announcement landed in a market already dealing with multiple competing narratives. The PCE inflation report came in largely as expected, but the annual core figures remain elevated, particularly the supercore inflation measure tracked closely by the Fed. Crypto fell sharply, down roughly 9% across the major index. Oil prices continued their recent drop, easing some pressure on central bank rate decisions. Treasury yields pulled back modestly across the curve. In that environment, a 9% single-day move in a Dow component like Comcast stands out dramatically. It signals something important. Even in a week full of macro noise, the market rewards decisive corporate action. Companies that take control of their own narrative in uncertain environments tend to get noticed that this week. Asterisk asterisk. The bigger takeaway for your portfolio, asterisk asterisk. Most everyday investors only think about buying or selling individual stocks. They rarely think about corporate structure as an investment signal, but spin-offs, mergers, and restructurings are often the clearest signals available. When a company voluntarily breaks itself apart, it is usually saying one of two things. Either we believe each piece is worth more separately, or we need to protect our most valuable asset from our weakest one. In Comcast's case, it looks like both. The broadband business deserves a premium valuation it has never received inside the media conglomerate, and freeing NBCUniversal gives it optionality that the combined company never had. That is not just a media story, it is a lesson in how large companies signal value to the market, and for investors paying attention, those signals are worth more than most earnings headlines. The markets move fast right now, and the real stories are often buried under the obvious ones. What you do with that information is up to you.